Hello and welcome to our April International Tax Newsletter. It's finally starting to look and feel a bit like spring here in New York. This has been a busy month for international tax developments. It's not what has happened, it seems like it's what has not happened. Let's start with digital. The European Commission introduced its proposals, both short-term and long-term. Short-term, a 3% turnover tax on digital services. Long-term, redefining PE to include what they call an SDP, a significant digital presence. Of course, they were beat to the punch by the OECD, which issued guidance the week before. The OECD has indicated that there is no international consensus, and so they're going to study this and issue guidance in 2020. Elsewhere in Europe, the European Commission issued their final decision in the Amazon state aid case. And the Netherlands, in response to a loss in the European Court of Justice decision in Ericsson, has changed their Dutch fiscal unity rules retroactive to October of 2017. And while this is initial guidance issued by the Ministry of Finance, I think it's important to look at, because if you have a loan between two members of a fiscal unity member, it is possible that the interest is disallowed for one member while the interest income is still taxable. In Australia, they've proposed legislation for anti-hybrids. That still has to go through the legislative process, but it could be effective as early as January 1st of 19. This sort of fills out the trilogy of provisions, the MAL, the diverted profits tax, and now the anti-hybrid. They also issued additional guidance on the diverted profits tax. Maybe the last thing I'll mention is in the US, we've issued a Q&A with respect to how do you report, pay, and make elections on the tow charge. If you've already filed your 2017 tax return, you may need to go back and take a look and perhaps amend that. And with that, I'll leave you to it, and happy reading until next month.